Unrest in the Middle East, nuclear disaster in Japan, a shaky recovery in the developed world economy. It's a confusing mix for energy investors, which is why we asked Dan Rice to join us here on the Inside Track. Dan manages two multi-billion-dollar energy funds for BlackRock, and he's in Boston this morning. So, Dan, which trends are you betting on?
I'm betting on the trend that there are lower-cost substitutes to oil, and that over the next 4 or 5 years, those substitutes will gain in importance and represent a great opportunity for investing.
Substitutes in what form? Nuclear was a potential substitute. Many people think that's off the table for at least the short term. Wind, solar, natural gas, what do you like?
Right. So wind and solar will increase in importance due to subsidies and tax credits. But look at the big picture. We're consuming about 30 million barrels a day of oil and coal in the United States. Wind, as important as it is, and solar will add about 1 million barrels a day of new capacity by 2015. So it's not the solution. The solution out there right now is shale gas. And it's just started. It's actually the new technology. We only discovered the importance of shale gas probably 3 or 4 years ago, and it's imperative that we get this particular energy source into our economy in a big way.
Dan, you're certainly even more familiar with the concerns around shale gas and hydrofracking than even I am. So as an investor, and this is the important point for us to make here, you don't believe, I take it, you don't believe that the opposition largely centered in the environmental community is going to stop shale gas development from proceeding forward at a fairly rapid clip here in the United States?
Well, I think when people really understand the facts, they'll realize that the hydraulic fracturing process itself is completely safe. There's never been an example of shale gas migrating into a shallow gas formation. In fact, when you see the movies and you see the shale, you see the gas coming out of the faucet and being lit on fire, that's not gas from the shale formations that have been hydraulically fractured. That's gas from shallower formations. And you can easily prove that by chemical analysis. So it's a little bit of a sham in terms of the hoax that's being played on people, that it's actually coming from the shale and it's a function of the hydraulic fracturing, because it's not.
Okay, and you may be absolutely right there. I know some people would debate that point, but as Daniel Yergin, the noted energy analyst, pointed out in a story or an opinion piece this weekend, just one incident involving a single well can become a national event, not unlike what we saw happen to BP and the Deepwater Horizon well in the Gulf of Mexico. Isn't that a significant investment risk?
Well, it could be, but there's been 40,000 wells in the last 40 years that have been hydraulically fractured. There hasn't been one where the hydraulic fracturing itself caused any gas to migrate into shallower reservoirs. So far, that's just an empty fear.
Okay, let's talk about how you actually make the translation from theory into investing practice. We know now what you believe. How does it show up in your holdings? What positions have you changed? What stocks do you like as a result of your belief that shale gas is going to become an even bigger and bigger reality for the American energy industry?
Right. I mean, the problem investing in shale gas today is that we have a large supply of shale gas today, and prices are low. As a result, we need to stimulate more demand to take advantage of that energy source, which is less than half the cost of crude oil. So I think that's going to happen, and the market will recognize that. If it doesn't, we'll continue to have buyouts in the group by the majors that do have a longer-term perspective than sometimes the market does.
More Exxon, XTO type deals.
Right, and you're seeing that all over the place, and that will probably continue.
Okay, now, how does $100 oil factor into this? You pointed out that gas prices are low, and as we see more evidence that there are more and more reserves of shale gas, maybe gas prices won't recover. Is it not a better bet in the short run, perhaps, to bet on $100 or more oil?
Yeah, it would be if the stocks weren't pretty efficiently being priced out there. The market realizes prices are high, and they're discounting the stocks for about $90 to $95 a barrel crude price for the foreseeable future, the next 3 to 5 years. So a lot of that is already in the stock market. I don't think that's where the real opportunities are. I think the opportunities are in the energy sources such as shale gas, which is being priced today in the market at around $25 a barrel, and the the price umbrella that oil gives that to rise to $40 to $50 a barrel equivalent in the next 4 or 5 years.
Dan, if there's one or two names, if there are one or two names that you think are the surest bets for shale gas, what would they be?
Equitable and Range Resources.
Okay, and Range Resources, we just had the CEO here just a little while ago talking about the multi-billion-dollar development plan he has for their shale gas projects in the Marcellus Shale in Pennsylvania. Dan, very good to have you here. Dan Rice, a co-lead manager of the BlackRock All-Cap Energy and Resources Fund. He, in fact, manages two multi-billion-dollar energy funds for BlackRock. Just telling us there, don't bet on $100 oil. Look to shale gas as the next great investment opportunity in energy.